As you already know, a hedge fund is a pool of funds wherein celebrities like sports personalities, movie and film stars, business tycoons, and other high net worth individuals invest their money with a hedge fund, and the hedge fund manager is continuously watching prices across assets, across markets, across countries in order to deliver a great return to these investors. Who are these investors? Why do they invest in these hedge funds? Hello, everybody. I'm your learning partner, Sushila, and in today's video, we're going to take a look at who are hedge fund investors. I've already uploaded two videos on hedge funds, the first video being on the structure of the master feeder, and the second being the fees that hedge fund investors pay to the hedge fund for outperformance. Hedge fund activities include investors investing millions of dollars into a hedge fund, the hedge fund pooling this money, creating a pool of these funds, and investing in different assets in different countries, in different markets across currencies, in order to deliver a high performance called as alpha. The contents of what the hedge fund does is already uploaded in an earlier video on the global activities of a hedge fund. For all these activities, the hedge fund managers charge fees. Investors who invest in the hedge fund and create that pool must pay fees to the hedge fund. The fees could be annual fees called as management fees, or they could be performance fees. The fees that are paid annually is called as management fees. The fees that are paid by the investors to the hedge fund on the basis of their performance is called as the performance fees. The performance fees are paid only if there has been an outperformance over the high water mark. Let's take a look at who are hedge fund investors. Hedge fund investors could be qualified institutional investors. These could be other hedge funds itself, or pension funds, or even family offices, etc. These institutional investors are qualified by SEC as institutional investors, and only they are allowed to invest in the hedge fund. So why is there a criteria for investors? Because hedge fund investing is a very risky business, and investors must be aware about the risk involved in the business. And hence, SEC says that let there be institutional investors, and if there are individual investors, they should be accredited individual investors. SEC says that these accredited individual investors must be qualified to invest in the hedge fund. So, what do we mean by qualification? What is the criteria that hedge funds use to decide what kind of investors can invest into their hedge fund? The first criteria, as on the date of the investment, the individual investor, must have a minimum net worth of at least $1 million. Now, this is a slightly dated regulation in the sense that this regulation was enforced almost in 2006. So, obviously, times have changed, money has multiplied much more, and the value of 1 million today is much more than that. But some funds continue to hold the minimum net worth criteria as $1 million. Is there no other criteria? No, there are two more criteria that are there. Obviously, monetary criteria, not educational criteria, because hedge funds is all about money, 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 money. The earned income of the individual investor should be more than $200,000 per annum in the preceding 2 years of the investment. Okay? So, this is the second criteria. The first criteria is that the net worth of the investor should be at least $1 million. The second criteria is that the earned income should be greater than $200,000 per annum in each of the preceding 2 years. Not in both the years combined, okay? In each of the preceding 2 years. The third criteria is that the investing year income should also be greater than $200,000, since the year of investing could be any point of time during the year. The investing year income is an expected or a projected level. These qualifications vary from fund to fund. Some funds might have minimum net worth of 10 million, some funds might have minimum net worth of $5 million, etc. There is no regulation with respect to how each fund decides what should be the accredited investor qualifications. Once the investor demonstrates these three income and net worth criteria, then they are given a qualification of accredited investor, and then they are allowed to invest into the hedge fund. Let's take an example from, as usual, my favorite Pirates of the Caribbean movie. Jack Sparrow wants to invest in hedge funds on 1st April 2022. This is not an April Fool's joke. That means on April 1st, 2022, Jack Sparrow must have a net worth of $1 million. The annual income for the year ended 31st December 2020 should be greater than $200,000. The annual income for the year ended 31st December 2021 should also be greater than $200,000. The expected annual income for the year ended 31st December 2022 should also be greater than $200,000. As I said, these are just examples that I have taken. If the investor actually goes to the hedge fund to make an investment, then the qualifications could be completely different. So as we see here, for the 2 years, preceding 2 years, in every year, the annual income has to be $200,000, and the projected income in the year of the investment. So he wants to make the investment on 1st April 2022. The expected annual income should be for the year ended 31st December 2022 should also be greater than $200,000. All right. The investors who invest into a hedge fund must be willing to take high risk. They should be aware about the risks involved while investing in a hedge fund. They are highly sophisticated investors. They are very market savvy, and they are very clued on to what is the financial situation, the macroeconomic situation, etc., because they need to have better returns on their earnings. These investors should also be willing to stay locked in. Okay? Many hedge funds have stringent regulations with respect to keeping the funds locked in for a period of time. Some of them could have a hard lock-in, some of them could have a soft lock-in, and some of them could have both. So therefore, if the investor is willing to stay invested without having the pressure of a lock-in, only then they should go in for investing in a hedge fund. Hedge funds charge a very high fees, as already explained in the earlier slide. The fees could be 2:20. That is, 2 is the management fee, 20 is the performance fee. And if the investors are willing to pay these kind of very astronomical fees, only then they should enter into investing into the hedge fund. Thank you everybody for watching this video. Please pass your comments and share your feedback on the comment section below. I love hearing from you. Thank you so much once again.